crore. As on 31st December 2021, we have incurred 1,363 crore from the budgeted amount and made significant progress in enhancing our capacity. We have further spent 145 crore in the month of January, February, and we are all on schedule in the progress of our capex spends. Out of the proposed capacity expansion of 5.9 million ton of aggregated integrated capacity, we have already announced the commission of 2.05 million ton of integrated aggregate capacity, which comprise of addition of 1.2 million ton of pellets, 0.72 million ton of DRI, 0.05 million ton of billets, 0.08 million tons of long steel products. Along with that, we have also commissioned the 40 megawatt of captive power plant. In addition to this expansion, we have also commissioned the state-of-art aluminum foil plant having a capacity of 40,000 metric ton with a projected cost of 360 crore, which has already been commissioned. The remaining projects, which are in the various stage of implementation, and we shall keep informing and update our stakeholders as and when the completion for the same are achieved. Coming to the phase capex, which was announced yesterday, aggregating 2.8 metric ton of per annum, which comprising of 2.4 million ton of pellets, 0.45 million ton of coke oven plant with a total capital outlay of 990 crore. We are expanding our pellet capacity both at our Jamuria and Sambalpur plant from 1.8 million ton to 3 million ton each by adding 1.2 million ton of pellet at each location. In aggregating the post this expansion, our pellet production capacity shall be combined with 6 million ton per annum. We expect to complete this expansion by September 2023. With our increased DRI capacity, the present pellet cell mostly caters to our internal requirements. Over the last decade, the pellets produced by us have been well accepted both in domestic and export markets. The present expansion will facilitate in keeping us as a result producing in the market for each 1.2 million tons per annum at a capital outlay of 180 crore is expected. In aggregating, the capex cost for 2.4 million tons, which will be emphasizing of 360 crore. Going to the present situations, our team of experts have also find it imminent to set up a coke oven plant along with the blast furnace being set up at our Jamuria plant. We shall take up the setting up of 0.45 million ton of coke oven plant, which is expected to be completed by September 2023. The cost of this coke oven plant is 450 crore approximately. The increase in capacity has led to higher volume of raw material requirement. In anticipation of the same, we are also proposing to add 2 lines to our existing 2 line of captive railway siding at both our plants in Sambalpur and Jamuria. This time around, we also plan to add wagon tipplers for smooth handling at our both plants. The same shall be achieved at a total outlay of 90 crore at each plant. We shall prioritize near-term capital spending on expanding asset base with the increased capacity to boost our future potential. I would also like to happy some key highlights of our expansion. The project shall be set up, which we are announcing yesterday, is totally a brownfield extension on the existing land available at a respective plant. Second, the new project extension entail an increase of 25% over the 11.6 million ton of integrated aggregate capacity post-expansion suggested in the IPO. The increased capacity The post current announcement will be 14.5 million tons per annum as a integrated increased capacity. The new project will be aligned with our sustainability goal as the company continue to focus on its environmental footprint. The budgeted incremental capex will be approximately rupees 990 crore, and the same will be funded completely through internal accrual. On a 9-month basis, I would also happy to announce that the company has almost double its revenue and triple its profit, and a testimony to our focus on keeping costs in control. We have one of the lowest cost of power in India, and almost 80% of our power consumption is made through captive generation. Our focus has always been managing cash flow and improving working capital efficiency. This has led to our strong balance sheet. We continue to witness improving traction at every optimistic of scaling operations further. We thank you all for your continued support and looking forward to continue interaction with you. Now we can proceed with the question and answer session. Thank you very much.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Yeah, good evening, sir, and thanks for the opportunity, and thanks for giving this comprehensive business update. Just 2 questions from my side. The first one is essentially on the capex. Now, if I look at it from what you mentioned during IPO and the run rate for FY23, while progress has been made on upstream side, pellet and sponge iron, but we still have to see some tangible progress on steel side, particularly billets and TMT, even ferroalloy. So is it possible to mention that what kind of capacity would we see for these three business centers by end of FY23? That is the first question.
Yeah, hi. Very good evening, Amit. Related to, the steel capacity, the long product facility, we expect to commission both in our Odisha plant and Bengal plant very soon. Maybe, we expect that by June, July, we'll be commissioning around 4.5 lakh ton of capacity comprising of both the sides. And related to the ferroalloy, I would say that, since we have not shared a very major expansion in our IPO in the ferroalloy expansion, but we are putting up a low carbon alumina ferrochrome plant, which is under the final stage of erection and commissioning, and we expect the commercial production should start from end of April.
So this, just a follow-up, this 0.45 you mentioned is for 0.45 for billets and 0.45 for TMT and structural.
Correct.
Okay, great. The second question essentially is that, first of all, this is a good example of capital allocation, that 990 crores is being allocated towards, capital expansion, particularly in coke oven plant, which you would require at a later date. So just wanted to get a sense on, have we decided where we are going to kind of get our coking coals? I know it's still early days and we don't require as much. but any thoughts around that, given the volatility in coking coal prices we have seen? Do you still think it is very prudent to go ahead with this, blast furnace style of expansion rather than furthering your ambitions in maybe DRI, IF, where you have a great degree of competence?
No, very, very intellectual question. Today when we are talking, today is a very, very different scenario. As I have mentioned that it's more a geopolitical, concern which is going around the globe, and we know the complete logistic on the sea front and lot of issues have arisen in last couple of months. But this is, never going to remain the scenario like this, because steel, coking coal, these are the raw materials. And where Shyam Metalics is concerned, as we all know that we are buying the pig iron from the pig iron producer, and if we are putting up this coke oven plant, it is going to add more value in reducing the cost, because if we see the cost of the pig iron, whatever we buy, always we see there is an EBITDA of around 3,000 to 4,000 rupees per ton. So it is rather going to reduce the cost of our existing steel making, and also will help us to consolidate on the solid platform where the group is concerned. And one of the very distinct advantage what we have in our existing new proposed coke oven plant is we are setting up a VDO technology, which is a very, very efficient technology on the coke oven front. I will just like to brief you. As you know that the performance of the company from the technological side, from the efficiency side, from the number side has always been very, very incredible. And we would not like to take any chance from where the availability or the performance or the cost structure on the variable side of the coke is concerned. So, generally if we set up any long horizontal coke oven plant, it generally, we get a yield of around 70 to 73%, where, the finished coke which is used in the blast furnace is around 75 to 76%. But in this video technology, we will be generating more power because it's a non-recovery type, and the power will help us to reduce our cost of energy because we are not going to burn coal for making power. Number two, it will also help us for the better yield in the blast furnace, because we can't depend on the coke supply from the international market. As we know, the coke business is very, very volatile, number one. Number two, there is a huge volatility in the quality aspect also. Apart from that, this coke oven plant also being one of the latest plant with 22nd century technology, it will help us to reduce the cost of the coke, the consistent quality for our blast furnace, and it will help us a lot in the availability of the blast furnace. So I would say this is a very, very necessity to create a very strong backup fundamental from the supply chain management point of view, from the energy cost point of view, and since we are very localized plant which is in the bed of the availability of coking coal, we will have an advantage of using around 30 to 40% of the domestic coking coal which is available from the Coal India, by washing it and blending it with the imported coal, which will help us to reduce the coke price in comparison with the international price. Thank you.
Yeah, thanks a lot. Appreciate your comprehensive answer. Thanks and all the best.
Pleasure is all mine. God bless.
Thank you. The next question is from the line of Ashutosh Somani from JM Financial. Please go ahead.
Thanks for taking my question. Sir, this is a more steady state question on your capital allocation. So essentially, over the next couple of years, what is the kind of capex you're comfortable doing as a percentage of your cash flow from operations on a steady state basis? What kind of IRR and ROEs you have in mind when you look at a certain project? That's one. The other is a more operational question. In terms of this current rally in prices from Jan, has it hurt demand in any way so far in the industry?
Hi, Ashutosh. Yes. When we are talking from the capex allocation point of view, as we are well aware that we have been a very, very prudent company, and since last 2005, after seeing the three turmoil, we had been always the least leverage or the no leverage company. So we are strategically, fundamentally, we are following the same precedents. And on an average, on the cash flow side, generally we maintain around 60% plus minus 5%. But from the IRR point of view also, whatever projects what we do, generally we make sure that it should be more than 17-18% of the IRR what we compute in our system, and that also on the very, very conservative side. And related to the January onward, if you see, since I have always mentioned that if we compare Shyam Metalics with any other steel company, we are very, very distinct, very, very different. In the comparison with the raw material side, which is a strength, today, we are procuring more than 60% of our carbon, or maybe 70% of the carbon from the local source, that is Coal India Limited. We have linkages. We buy at the spot link auctions as well, seeing the market scenario of the realization of our raw material vice the sale of the finish. And if you see where other companies, they have really suffered on their numbers of margins, and Shyam Metalics has really shared better numbers in the toughest scenario when we see from the September to December quarter also the EBITDA margin was very, very decent. And I personally feel from Shyam Metalics prospect, we are on the better side, where this turmoil, what we are seeing in the increase of the raw material, though it has impacted us also if we see from the base price, but from the realization side, the numbers are going up, the delta is better. The steel prices are majorly dominated by the coke price, as we are all aware of, and the dependency of Shyam Metalics is on the coal price. So we are definitely on the better side, and in the time to come also, the increase in the coal price, the increase in the international iron price is definitely going to be more and more beneficial in comparison to the delta. But once we see the base price numbers of the raw material cost, definitely we will also have a hit. But on the margin side, I'm very, very positive that we will be on the better side.
Sure, sir. Just a follow-up on the second aspect, sir. The end product prices being high since January, has it in any way impacted the demand from your customers?
See, I would really say at this point of time, there is little bit of stiffness because, whatever the systems, inventory and all people in between, they are used to, they become little bit concerned. But where Shyam Metalics is concerned, I don't see any kind of a stock situation, to be worried of, because we are very, very localized B2C business plan. If you see, like most of our customers are within 500 kilometers, and the product where we are catering is generally, in the sector where we have a great strength of our marketing and trust. And we are able to convince the customer, from the price front that though it is on the higher side, but they should not expect. So we are able to cope up. But I would definitely not disagree on the fact that there is little bit of tightness from the buyer side. Concern is there, buying at so high price, because if you see, there has been a price increase of around 30% on the steel price. But simultaneously, I would say the demand is also very, very strong. As we all know that a lot of project is happening across the country. And as a product where we are into has a great potential in our Indian economy, in our Indian development also, as well as in the export.
Sure. This is very helpful, sir. Thanks. Thank you.
Thank you, Ashutosh.
Thank you. The next question is from the line of Prashant Kumar from Dolat Capital. Please go ahead.
Sir, good evening and thanks for the opportunity. Sir, looking at the projects that we have announced, the fresh round of expansion and the kind of capex outlay at 1,000 crores. Sir, back of the envelope, broad, rough calculation suggests that the payback period is as low as probably 2.5, 3 years. So we were kind of wondering how is it possible to get this project done under such a low capex cost, apart from being a brownfield, etc. I know you have a lot of expertise, but if you could explicitly highlight some of these aspects as to how you are able to pull this off in such a low capex and a very healthy payback period. You could throw some light on that.
See, for every project, if you see around 25-30% is the infrastructure cost, when we see from the land, power, water. And since we have a very strong domain in the steel, we understand how to rationalize, the cost. We have our own engineering experts, and this is the way, this is the success mantra of Shyam Metalics. Like whatever project we had committed in our IPO or we had been committed in the past of doing the capex in the power plant of around 3.5 crores per megawatt, we have been able to benchmark below that. So basically, if you see, when we are adding a pellet plant, there are a lot of infrastructure like metal handling plants, so many other issues are there, utilities, your powers and all, everything was inbuilt, keeping in provision of the future expansion. So it is nothing, it is just engagement of the core equipment at a place where you have your own expertise of project management, your team in place. We have our own civil management where we have, own expertise, and we use a lot of our internal infrastructure of world class of capital civil equipment to make sure that we are able to do before time, and it saves a lot of cost.
Understood, sir. That's helpful. And sir, my second question is on the prices. What we are seeing in the long products in the market now is about 72,000 rupees on the long side, the TMT, that side of construction steel. Compared to that, broadly, if you could tell us where is our pricing and then broadly.
See, there are different kind of a pricing. When we are talking from the long product point of view, we have a network sale, we have an institution sale. But on an average, I can say the market has softened in last 1 week because of the festival, the Holi and a lot of issues are there. So, but on an average, if you see, when we are talking from the long product price of 72,000, it's not basically the reflected price at the MRP in the market, but there are a lot of discounting factors, a lot of, incentive factor, what we pass on to the distributor dealers in our network sale. But on an average, I can tell you, Pankaj, can you just brief me on this? 62,000. Approximately, 66,000 should be the ex-NCR. Am I right? Yeah. Around 64,000 should be the ex-NCR. Presently, yeah.
Understood, sir. Thank you, and all the best.
Pleasure is all mine. God bless.
Thank you. The next question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question. So I have two questions. First of all, on the raw material inflation side, how are you sort of planning, your course of action for the next couple of months? Because that would also require certain more working capital deployment as well. And secondly, regarding this, very sharp increase in scrap prices globally, almost, Turkish scrap has gone up by almost $150 in the past 2 weeks. So had that flown into prices of longs in India, or that is, yet to flow in? And how is the supply or the availability of scrap? Is that restricted right now, or you see scrap flowing into the market freely? Thanks. That's all from my side.
Thanks, Abhi. As you know that we are not a very scrap dependent plant, and we are completely on our captive sponge iron what we use. So we are definitely getting a super advantage on the pricing side, because it is always advantage for us more and more if the scrap prices are there. It is easy for us to increase and enhance more value on our finished product. So first of all, I can just share my thought that all the coastal plants which are dependent on the scrap, their cost goes up, and we are able to share a lot of our material in the other part of the country with a better realization. So it is always a super advantage for us. Number two, when we are talking from the raw material prospect, as we know that, we are not dependent on the coke and all, and we are more dependent on the Coal India for the supply of coal, and we are on the bed of the coal. Yes, definitely, there has been an increase in price. I would not deny on that. But if you see the delta, like the price what has been increased in the carbon cost, vice versa the price what has increased in the finished product, vice versa the coking coal price, we are in a very, very advantageous position. We are able to increase more value of the product what we sell, and also the delta margin. Related to the iron ore also, we are also very near to the iron ore mines, and we have some long-term contracts on the supply side, some long-term commitment and all. But definitely it's never 100% on that. There is some increase on the iron ore. But overall, I can tell you that the margins are better for us, because it always gives a more advantage when the imported price of the when the import price of the iron ore goes up. The coastal industry, they suffer more, and the international price of the steel goes up. So it penetrates the company more better side from the raw material side as well. Thank you.
Thanks.
Thank you. The next question is from the line of Bajrang Bafna from Sunidhi Securities. Please go ahead.
Thanks for the opportunity. Sir, in terms of our raw material integration, could you throw some more light? Like we have, linkage coal from Coal India. So how the pricing, is done for this linkage coal? Because now there is a tremendous, pressure on the international market, and, we are not a priority sector for Coal India. So in terms of availability and in terms of contract, if Coal India doesn't honor that linkage, so how that mechanism work? If you could make us understand, will be really helpful.
It's a very right question. I would just like to share that, we don't work on the yesterday's inventory management. So when we are running such a big integrated plant, we have a good line of inventory management, and lot of long-term contracts are there. And Coal India, they always have a problem in evacuating the material by rails. The advantage what we get is, since we are the next door plant from the mines, there is never a stopple or any major concern from the roadside. Generally, the restrictions comes on the rail side. Number two, like we have linkages, we also buy through the auctions. So we always do an average of taking the advantage time to time, seeing all the price of the raw material and all. But yes, the raw material price have definitely gone up. There is no, I would definitely agree what you are saying. But if you see the percentage of raw material which has gone up, the prices of the finish has also gone up. And if you see the margin from the cost versus the finished prices, we can definitely determine that it has been completely passed on with major advantage on the pricing side as well.
Yeah, I got that point very rightly, sir. But in terms of our expansion, like we are now entering into an expansion phase, and we will require more coal in times to come. So we might have some sort of integration in terms of linkage with Coal India on our existing capacity. But when we are going for this expansion spree, can we expect the similar sort of percentage linkages? Like if I'm not wrong, it is 70% linkage and maybe 30% through other sources. That is what I could gather from reading your material, and it's a new company for me also. So if you could just give us some sense from a future expansion perspective, what sort of linkages that we'll be having.
See, I'm just briefing you on this. If you see, there are a lot of the Coal India in last 1.5 to 2 years have auctioned lot of mines. What is really going to happen today? All the big companies, the aluminium company like Vedanta, Aditya Aluminium, so many companies, they have taken our mines. If I see a long-term goal, whatever expansions we are going ahead, I see that lot of these big companies are going to convert into their captive mines. And Coal India is also enormously taking that production with a huge goal of producing more than 1,000 million tons. If they don't produce 1,000 also, which we also understand that what they are targeting and what they will be able to do it. But still there is a lot of gap. We have an advantage of our plant being in the Coal India belt. We have an advantage of lot of other benefit of having our railway sidings. We are connected with lot of collieries. We are connected with lot of subsidiaries of Coal India. We are not dependent only on MCL. So this is an advantage what we have, and we should not be worried on the energy coal side. This is just a phase, and this will really help us in next 2 to 3 years when we will see a lot of these mines are going to open up. The Coal India is going to ramp up the production, and 100% with my understanding of my business, the company like Shyam Metalics, which is completely majorly 80-85%, 90% dependent on the local coal, is going to get a very good advantage.
Okay, got it. So, in terms of iron ore also, could you just throw some more light when, we are expanding capacity and we are again totally dependent on the local availability. We don't have any iron ore mines. So in future, any plan to integrate that part? Because most of your competitors, if I see, they are clearly at an advantageous position in terms of their integration of iron ore mines. So are we doing something strategically which can, maybe over next couple of years could give us, that kind of insulation?
See, when we are talking from the iron ore mine prospect, it is not that we are not participating, but our strategic business principles are that all the business has to be on the IRR basis. So the major mines which has been auctioned has been gone at a no IRR or minus IRR. Number two, we have a linkages from OMC Odisha Mining Corporation, which is one of the largest resources in the country we have. They are also expanding their mines. The bigger, the steel partners, they are now consolidated with their own captive mines. So I see in the time to come, we will not have any kind of a concern because we have been always in the iron ore scenario of crisis since last 2005-6, and we have always taken the advantage of our location, our linkages, and in the time to come, if we are able to get a good mines at a good IRR, we will definitely offer that as well.
Great. Thank you very much, sir, and all the very best.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The next question is from the line of Aman Madreja from Augmenta Research. Please go ahead.
Sir, can you just let me know about what percentage of pellets production is used captively consumed and what is sold outside? Like a number.
See, today, more than 70% of the pellet what we produce, we consume it. And whatever expansion we have done and which is in process, whatever pellet we are producing, it will be consumed internally. Our new capex pellet plant will help us to create our presence in the pellet market and also will help us to create a future expansion in the time to come, see the market scenario and our capex allocation plan.
Okay, sir. Thank you, sir.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The next question is from the line of Bajrang Bafna from Sunidhi Securities. Please go ahead.
Thank you for the follow-up question. Sir, if we just try to understand the international, opportunity which is arising because of, all this doomsdays of war and all, it clearly indicates that, there is a tremendous opportunity which is coming for India in terms of, export opportunities also because, because of this raw material scarcity and all those prices zooming up in the European market, and they are going for a severe, energy crisis at this point of time, and the production is going to be damn difficult there, and this will also, open up a lot of export opportunities. So have we started seeing, some sort of, those opportunities coming to our side, especially from this crisis, which we could tap, in the foreseeable future?
Presently, if you ask me, I would say that it is no, but the reaction has already started in the penetration of the raw material disruptions. The prices has gone up. Now, in the time to come, maybe from next quarter onwards, we will see that things should definitely space up in India. Lot of inquiry is there, but it is not a very, very, serious inquiry because all the traders who are in the business of steel internationally, they are watching the Indian market. They are trying to understand. And I'm confident that we will start seeing some movement in the coming quarter.
Got it. And sir, more of a strategic question, like we are into basic products of, the iron ore industry. But in terms of specialty steel, which are purely, I would say the future in terms of higher margins business, and there is a whole lot of support from government, on that side also. So are we, doing something or thinking strategically, on those lines, maybe from next 4-5 years perspective, which can, take us, in terms of more margin augmentation from those specialty steel perspective? So if you could share your thoughts, will be really helpful.
I am not very apprehensive on the specialty steel right now, there are 2, 3 reasons like, if you see the major utilization of the specialty steel, alloy steel, is in the auto sector. And we are seeing there is a huge turnaround changes happening in the DNA of the auto sector by the electric vehicles. So whether watch, and we have been always very prudent and very, very conservative company. So as of now, if you ask me, I see there is a lot of opportunity in our existing products. We have a control on the cost side, on the technology side, on the resource side, on the market side. We would rather more focus to grow in the present products where we are into, but definitely not very positive on the alloy steel side as of now.
Got it. And in terms of, sir, our, power cost, which we, it's a commendable that still we are at 2 rupees 10 paisa kind of number, in terms of cost of power. So given the price escalation of coal and given the expansion that we are into, are these numbers manageable or, can we see, even if, considering the current cost and all, where this cost can go up, in the foreseeable future?
Presently, if you ask me, like if you see the major cost of our power which we dominate is, we generate a lot of power from the waste heat recovery, the byproduct, the washery rejects and all. Impact of coal is definitely will not have a positive side on the cost. Will definitely going to impact. But honestly, at this point of time, since, all these episodes has happened in last 2 weeks time, and the market is very, very volatile and we have not taken any position. So I will not be able to comment you right now. But yes, definitely there should be some impact, but we should not be worried of, because if the product is able to fetch you a better margin, and if you are able to get the benefit of this carbon more than, and more you get the value on the product side, we should not be bothered. But yes, definitely there will be an impact, but I will not be able to comment you on the impact right now.
Got it. And sir, more, slightly not associated with our company, but if we see in the global market, the cost of carbon production is increasing, and, there are companies, who cannot emit beyond a point and they need to make it good through carbon credits. Yes, this concept has not come in India as of now, but, there are companies in the world domain or JSW, who are already talking about, carbon neutrality over a period of time. And there are a couple of Indian plants who are already talking to LanzaTech, in terms of, reducing their carbon footprint by adoption of, this direct carbon capture technology, which the LanzaTech is providing. And there are a couple of global, steel players who are already talking to them. So are we thinking on that direction, anything that we are also planning from a medium to longer term perspective?
When we are talking from the green steel prospect, we are all aware about that, what is the price of the scrap. People in India, they are thinking, evaluating, but if you really ask me, we are also evaluating, but at present it is not sustainable. So once the time comes and we see the sustainable value, because it's more important to see the sustainable value of the company, and we domain more on the local usage of steel in the country. And in the time to come, if we see some new technologies which we are talking on the hydrogen side, definitely we will evaluate. But on the real front, presently, I don't see any sustainable value. And yes, you are very correct. This, what the globe is talking, we also have a ESG board in our company. We are also evaluating how best we can do on the ESG front to minimize the carbon in the existing space. But from the technology point of view, if you see, scrap is not a workable solution presently, though everybody is evaluating. And in the time to come, when we see that it is a necessity and it makes business, definitely we'll evaluate.
Got it. And sir, my last question is your, holding is still upwards of 88%, the promoter holding. And what is the time frame that is available to you for, adhering to the 75% number? What is the time left, and what is your, broad thought process that how you want to, adhere to those 75%, promoter shareholding? So any comment on that will be appreciated, sir.
We are not governed by the time, we are governed by the SEBI's time. So,
Yes.
so we have to definitely abide with the SEBI nomenclature, number one. Number two, whatever new capex we are working on, we are still on the capex board stage, on the new project stage, apart from what we have declared. And in the time to come, once it gets mature, because we are very concerned on our capital allocation, we are also concerned on the proper utilization of cash in our company, and we are also concerned on our respective dear shareholders' expectations. But definitely, it is under the review board, and maybe once we are ready with our full master plan, we will plan everything and intimate to SEBI.
Okay. No, I'm just asking that the 75%, promoter shareholding, what is the maximum time frame under which you have to adhere to that? So next 1 year or 2 year?
As far as SEBI guideline is concerned, we have to be diluted within a period of 3 years. The last year we have listed our company in the month of June, so we have enough time to dilute our equity to the tune of 75%, which will be diluted over a period of 3 years.
Okay, got it. But there are, a couple of media articles which are indicating that SEBI in the process of, bringing down this number from 3 years to 6 months. So, I don't know whether it is true or not, but this is what we have heard in the media a couple of times. So, just wanted, if any sense that you have got on.
I have never heard. What you are saying from 3 years to 6 years?
No, 6 months. 6 months. 6 months.
No, that is a lock-in of the, lock-in. No. I think there is some confusion. It is reduced from 1 year to 6 months. The lock-in has been reduced from 1 year to 6 months of the
prior shareholder before the IPO.
Yeah.
Okay, got it. So still we have 2 years to go, and adhere to this.
भाई तुमको शॉक दे दिए मेरे को ये क्या बोल रहे हो मेरे को लगा कि मेरे को मालूम
नहीं I was just talking to somebody and he has just indicated.
This was a dugli. Anyway, God bless. Thank you so much.
ठीक है. Okay sir, thank you very much sir, and all the best.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to Mr. Nachiket Kale for closing comments. Over to you, sir.
Yeah, thank you everyone. Thanks for participating in this call, and thanks for asking your question. And I'd also like to thank the management for sparing time today. And it was a very fruitful interaction with everyone. We look forward to more further interactions like this. We, Orient Capital, are investor relations advisor to Shyam Metalics and Energy. So for any queries, any data requests, please feel free to reach out to us. Either me, Nachiket Kale, or Rajesh Agarwal and Payal Dave also are at the firm. And I would like to thank everybody for your time again, and thank you so much.
Thank you everyone, and happy Holi to everyone.
Thank you. Ladies and gentlemen, on behalf of Shyam Metalics and Energy Limited and Orient Capital India, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.